Good afternoon, everybody. Welcome to our Long Options webcast today. Here in our Schwab Coaching, I'm Connie Hill. I am happy to see you join me here today. Now, how many of you get into or enjoy going to a place where they have a big smorgasbord and you can go around the table and sample this and sample that? Some of you might like that, some of you might not, but today we're going to do a little smorgasbord tasting here. If you like to trade earnings, we're going to do some earnings. If you don't like earnings, we're going to do some non-earnings. If you think you're bullish, we're going to do some bullish. And even if you think you're on the more bearish side, we're going to try to sneak in some bearishness. So that's why I say we're going to kind of have a little bit of a smorgasbord in terms of the new opportunities we're going to take a look at. Now, I hope you're following me on X. I'm Connie Hill CS. Cameron, who's helping me out in the chat here today, he is Cameron May CS. And we'll put educational content out there, things that we think you might find interesting. In fact, before I jumped on, I saw Cameron had a poll out there about where you think the S&P 500 is going to close at the end of the year. I think that'll be interesting to kind of see what the results are of that and what you guys think is might happen, right? We never know for sure until it actually does. Let's go ahead through our disclosures, and then I will lay out our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for educational purposes only. Don't consider it a recommendation of any sort. We'll use some technical analysis, which is pretty common with long option strategies, but you can also incorporate some fundamental analysis in there. Past performance of any security or strategy does not guarantee future results or success. We will be using the Paper Money Thinkorswim version of software. It's what you download to your computer. It's the most robust version of Thinkorswim. Very nice tools for option traders on that platform. Past performance does not guarantee any future results or success. All right, coming up, I'm always going to put a plug in this because I know you guys that go really enjoy it. Okay, these are our in-person events. They're not recorded. You're not going to be able to get them anywhere else. You have to be to those live. Okay, so next weekend in Miami. Nice time to be in Miami if you're somewhere where it's kind of cold in the winter, like where I am right now in Utah. Orlando, December 6th and 7th. That'll be a 2-day workshop with technical analysis and option strategies. And then a market drive in Houston on this. Oh, no, actually, this will be another workshop, technical analysis and options on the 13th and 14th. Okay. If you're anywhere near there, do yourself a favor and just go join one of these events. It doesn't cost you anything. We're so nice to you, man. We spoil you, we feed you, and we feed you not only food, but we feed you some great information to help you with your trading. All right, in our webcast here today, typically we talk about the different concepts and different things that are going to or will impact a long option. Things like price, time, and volatility. Of course, we always want to look at a few examples. And I want everybody to just kind of have some basis for long options. Now, I'm going to assume that you're familiar with options to some degree or not, and that long options, you know that you are buying these options, whether they're long calls or long puts. And typically, they're directional in nature. Now, what does that mean? It means we're looking for the stock to move. There's other option strategies where the stock doesn't have to move, and sometimes we might even take a neutral stance in some strategies. But with this strategy, we need the stock to move. So if you're looking at a stock and it doesn't move around a whole lot, either up or down, it might not be a good candidate to use for a long option. These positions are what we call theta negative. Theta negative means time as it marches on hurts the price of our option. Every single day that the option exists, it has a little bit of time decay in it. And of course, the closer we get up to option's expiration date, the more hefty that theta decay becomes. It's kind of like you're taking an ice cube and you're going over to the fire and you're just going to kind of melt the ice cube on the fire. And the closer you get to the fire, the more it melts. And that's kind of what's happening with the time value of our options. All right, so we want to make sure we understand that. We're going to talk a little bit about Vega today and the impact of changing Vega. Vega positive trades, which long options are, mean that if implied volatility goes up, it can boost the price of your option up. If it goes down, then the price of your option typically is going to go down. So we want to always keep that in mind. And in the event that you have a losing trade or trade doesn't work out for you, doesn't mean you're a bad trader, just means sometimes trades go against us. You could lose up to your entire net debit paid. And so you just always want to keep that in mind. Make sure your position size for what is comfortable for your account. All right. Will says, hey, if I'm going to go to a workshop, do I need to take any materials with me? Great question, Will, or rather a Will. The answer is yeah, you might want to bring a laptop if you have one. The speedier it is, the better. We'll usually have Wi-Fi for that. Yeah, we run cables and electricity and power strips that you can plug into those. So some people find that to be helpful. If you have a favorite pen you like to take notes with, maybe that, but we give you some notepad paper anyway. All right, and just bring your willing mind. Okay, that's what you would want to do. Now let's jump over to Thinkorswim here. And we kind of know what's been going on in the market. Market had just this really nice run. This is the S&P 500, and then it's kind of started to flag a little bit. After one of our classes yesterday, we were talking about flags, and if we see an index, which most of them are doing this, flagging, then we're likely to see some of those opportunities. But in this kind of a pullback, many times traders don't necessarily want to say, oh, I want to go all out bearish here, because the trend is still intact, and it's just kind of for that period of time, the option or the stock or the market, whatever you're looking at, happens to be pulling back. You know, today the S&P is down 0.6%, which is, I'm going to say decent, but not anything to be overly concerned about. Okay. Now, if we look at the NDX, it's down a little bit more. In fact, as the afternoon has worn on, these candles that were just kind of smaller red candles earlier today definitely are dropping a bit. And then our volatility index, that's always something that's good to keep track of. Remember, that measures the fear in the marketplace. Let's come out here to about a year chart. Want you to see the lows are down here around 12, 13, something, 14 in that area. And recently we were getting back down into those low areas. In fact, we are still here again. I'm just going to zoom into this point so you cannot get too thrown off by that spike. But yeah, it's kind of back down here in this 14, 15-ish area where volatility is fairly low. So even though we're pulling back today and fear is creeping up a tiny bit on the volatility index, it doesn't look like it's too alarming. All right. Now, I want to talk about a couple of ways we might use long calls and puts. If some stock is coming into earnings, and we've got one that many people are going to be keeping their eyes on next week, NVIDIA, let's go ahead and add implied volatility to the chart. So come over here to your studies if you don't know where this is. And there we go. We're going to type in IMPV. There's our implied volatility. We're going to put it on the chart. I like my volume on the bottom. Let's make the line here a little bit thicker so you can see it. We'll make it a 4. And then we can kind of see patterns with implied volatility as stocks go into earnings. All right, so let's take a look back here, first of the year. Down in January, February, here's our implied volatility line. We can see this is where the earnings were, right? And prior to the earnings, the implied volatility really ran up there pretty steep. You know, and by the time it gets to typically the week that the stock does their announcements, many times the implied volatility has already run up in that period of time. So we can see, yeah, clearly did that a few days before earnings back in February. Let's see about in May. In May, I'm going to say it ran up a little bit before the earnings date, but then you always see this big drop off, right? After the news comes out, whew, implied volatility comes crushing out of the options, causes the price of the option to get smaller just because there's not as much implied volatility there. It's kind of like you've got a balloon that's been blown up, and as it is ramping up implied volatility through a period of time like here, it's kind of like that balloon is swelling. It's getting bigger and bigger. Once the earnings is out, man, it just kind of sucks up and that air comes out. And that little piece that we attribute to the vega or volatility comes crushing out of typically all the options, but especially those that are close to options expiration. What happened here? Our last earnings, all right? We had a run up and then interestingly enough, kind of pulled back a little bit before our last earnings. That is a little bit curious. Now, coming into earnings, these guys don't announce until I think it's Wednesday afternoon. Yep, that's on the 20th, Wednesday afternoon, so about a week from yesterday. They will announce they've had a little bit of a run up, but maybe not as big as we might have expected, given maybe what they did back here. So if it's not ramping up a lot, then maybe the implied volatility priced into the options isn't too huge at this point. Okay, might mean the options are a little bit less expensive than they might be if implied volatility were higher. Okay, and that's something that we're going to keep in mind for a couple things we're going to talk about. Now, we've done this in our class where we bought a long call and a long put over earnings. And what we're going to do with NVIDIA is we're going to buy a straddle. Again, we're going to buy a long call and a long put, but we're going to buy them today. And what we're going to do is we're going to see if implied volatility ramps up so that maybe one side or the other is quite positive just from that implied volatility. Traders have seen things happen before when implied volatility goes up and both the put option and the call option go up because of that implied volatility. So typically NVIDIA has a lot of implied volatility. Maybe there's not a lot, as much as maybe back here in February, just because they've had such a long run this year that maybe the expectation of movement isn't quite as big, but we're still going to do that kind of as something to illustrate and show you how that might work. So as we come over here to the trade tab, because they don't announce until next week, we could look at a couple of things. One, we're not interested in the options that expire tomorrow. And we can see in the options that expire the next week, the next Friday on the 22nd, see how high that implied volatility is there. It's about 84%. And then if we go out a week further, then it drops down to 68 and 62 because most of the pricing, that implied volatility, that expectation of movement is priced into the week that the options expire. Now, in our case, we might say, well, which one do we want to buy then to make this observation? Well, if our plan is to get out of the call and the put because we're just trying to see the ramp up in volatility, we would want to be out before they announce next week. Okay, that's what we're going to do with these two options. Now, the price right now is almost 146 here. So our at the money option would be the 146 strike. We've got oodles of open interest out here, lots of activity here in the volume column as well. These options are very, very active right now. So we're going to buy both a long call and a long put. We're going to just do the at the money strike price on these. So I'm going to line them up. We're going to buy the call. We're going to buy the put. Oh, I'm off a little bit, aren't I? Let's undo that. Let's go 146 here. And then I'm going to get rid of the 145s here. All right, so we should have, oh, brother. Let's go. Let's try this one more time. Control key on the 146. Control key on the 146 on the call side where we're going to buy it. There we go. All right. So that's what we call a straddle when we're buying the same strike price at the money, just whichever one is the closest. And typically your at the monies do have quite a bit of implied volatility priced into them. So we're going to see if indeed they go up. Okay. We're not necessarily going to hold them over earnings, not this particular one. We're not going to do that. But let's go ahead. We're going to put it in. We're going to put it in our option strategies bucket, and we'll see. Now, if we have any classes next week before they announce that it's appropriate that I can bring it up in, then I will. Okay. Bring it up and let us see how that is doing, or I may report on it on my X account. All right, so not long verticals. We just want this into our long options. All right, there we go. We're going to go ahead. This is just letting us know, hey, this is not a monthly option. And also the other message here is that they might have to do something here. It just says concentrated positions may require a higher margin. We're actually buying both of these options as opposed to selling one. So I think we're going to be okay here. Let's go ahead. We're going to send this in. Hopefully we get filled here real quickly. Well, how else might we use a long option? Well, we could use it as a hedge. What if you're somebody that owns shares of NVIDIA? And you're like, they've had that big run up. There's a lot of, it's been tremendous this year. Maybe it's not going to bump up so much. Maybe it's going to drop. Maybe it disappoints a little. They haven't disappointed over the last 2 quarters because we've seen them pop, right? But if somebody wanted protection, let's just talk about that. Let's suppose we have 100 shares of NVIDIA and you were concerned about the earnings and you wanted to buy a little protection just in case things didn't go the way you expect them to. Now, when we're looking at time frames here, we talk about buy enough time for as long as you think you need the protection, right? It's kind of like pulling your umbrella out when it's raining, and when it's not raining anymore, you put the umbrella away, right? And then we sell it for whatever we can get out of it. It's kind of like it's done its job. Maybe it helps us because maybe the stock does drop, maybe it doesn't. Okay, so you pick kind of how much time, and if you're just doing it for an earnings event, some traders might just do the 22 expiration date here. Some might go out maybe even a little further if they think, hey, if it drops, maybe it might continue to drop, but maybe you still want to be holding on to your stock. So you might buy just a little bit more time. So that's what we're going to do in our scenario here. And I want to look at the December 6 options. That would give us what, about maybe 3 weeks after they announce to maybe let things settle in. Doesn't mean we plan to hold a long put that entire time. But as we come out here, you're thinking, man, I have a lot of choices. What put would I want to buy for protection? When people are trying to protect their portfolio, whether it's they're buying a hedge against the entire portfolio or just individual stocks like we're looking at here, you don't necessarily want to buy something that's a dollar for dollar hedge. Many traders like to use between something that might represent 25, like a quarter to a third of their portfolio or of that position. So what would that mean? Well, if you're looking for a quarter, you might look for something like a 25 delta. Okay, let me bring in a few more strike prices here. Let's just grab 28. We should be good there. All right, so where would our closest to 25 be? Got a 26 here, have a 24. So if you're just saying, yeah, I just want to maybe do a quarter of my position to hedge, you might choose something there. If you want more, then you're going to slide up in the deltas. You're going to come a little bit closer to maybe something in the 30s. If you're going to do a third of that position, then you might even really target a 33 delta here. Now, the idea with buying this is that you're looking for an offset. You're looking for a hedge in case the stock doesn't do what you expect it to do. Now, well, you're hoping it goes up, but if it drops and you're like, I would just want to make sure I'm protected because I really like the stock, even if it does have a little pullback. So this money that we might spend on it, let's say we went for this 139 strike price and it would cost us $485. We could potentially lose all of that. It might be a hedge that it's going to be 100% time value because it's out of the money, right? So we know all of it, 100% is time value. We know once the news comes out, applied volatility will come crushing out of it. We'll still have, time in there for basically how long we have the contract still in force, right, till it expires. So we have that portion of it. But implied volatility may come crashing out. So what you might want to think about this as you're using it as a hedge. You're not expecting to use it to make money per se. It's just to help offset in the event that the trade really goes against you. Okay, so really you could choose anywhere in here depending on what your mindset is as far as how much protection you want. So I told you we'd do the 33 strike or 33 delta. That's our 139 put. I'm going to go ahead. I'm going to buy our put here. We're going to suppose we have 100 shares of NVIDIA stock, and that is our hedge against it. We're going to go ahead. We're going to send it in, and we're going to put it in our bucket here. I'll show you how we manage it, okay? We may still be in it next week, depending on what happens, but if it's time to put the umbrella away, we don't need the hedge any longer. After the news comes out, then we'll typically just sell it and get what we can get out of it, all right? See what we can salvage. So we are going to put this in our long options bucket here as well. Again, it's letting us know, hey, these are weeklies. We know they're weeklies. They're not monthly expirations. So Naresh says, are we going to close the trade on NVIDIA, the long call and the long put before earnings? Yeah, that's going to be our plan. Our plan is to see if implied volatility ramped up enough that we're like, hey, we have a little bit of a profit here. Our intent is not to hold it over earnings. There's a lot of strategies you can use over earnings. In our class, because we're only talking about long options, then we might not explore other strategies that might involve selling a leg or, maybe doing a spread of some sort. We don't really talk about them in this class, but I'm sure that there are other classes you'll go to that possibly may bring NVIDIA up as an example because of earnings being next week and all eyes just glued to it. Okay, so we've got two trades on there, a protective put, and then we have our straddle that we're going to see if implied volatility runs up enough. Now I'm looking out in the chat and I see that we have a survey out there. All right. Those of you that join us frequently know that from time to time we'll do a survey, we'll put it out there. And the idea is we'd love your feedback. Okay. I read every single one of these that you fill out. Our managers do as well. And they're easy. I like easy surveys, right? Two questions. You can just go plop, plop, pick the radio button, 1 to 10, which one represents your feelings. If you want to answer a couple questions, we'd love that as well. But I'll also say, hey, use that as a spot for you to communicate with me. If you want to say, hey, my long option trades, I'm struggling with this, whether it's picking a strike price, picking a time frame, maybe not getting out soon enough, whatever it is that maybe you say, hey, could you maybe touch on this in one of your next classes? I would love to do that and incorporate what your questions and concerns are into our weekly discussion. Okay, so please do that for me if you want. Just click on the survey now, let it sit in the background, and then as we get towards the end of the class, or if it's time for you to leave, then go ahead and fill that out. We'll post it again at the end of the class, Cameron will help me keep track of that. All right, next up. I actually have a question for you. How many of you have not subscribed to our YouTube channel yet? I hope you all have. And I say that because it just makes finding our content easier. So if you're a subscriber to our Trader Talks channel, you can see our activity in a lot of different ways. Okay, you can see, in this case, what's coming up next after our class on long options. Get to know Schwab.com is going to be our class. It's going to happen right after we're finished with this class at the top of the hour. Brent Moores will be leading that discussion. He's pulling out some great things on Schwab.com. So if it's something you need to get a little bit better acquainted with, then that's going to be a fantastic class for you to attend. We have here some very popular webcasts. In fact, if you go down a little bit lower here, we've got a couple of Camerons having to do with Thinkorswim. And so those of you that maybe are newer to Thinkorswim, yeah, that might be a webcast series that you might be interested in. And actually, a couple of the popular ones that have got a lot of traction more recently are sitting here. So Cameron would love you to stop by, visit his videos. I'd love you to stop by mine as well. But it allows you to find our content really easily. Okay, so be a subscriber. If you haven't done that already, click on that little blue icon, YouTube icon on the bottom right of your screen. That allows you to subscribe. If you have already subscribed, don't click it because it will unsubscribe you. Okay, it's kind of a little toggle type button. Now we're going to head back over here to Thinkorswim, and just real quickly, I want to see how far, if the market's recovering off their lows or not. Looks like maybe a little bit. We've got a little bit of a shadow here. Pull up a stock here. YPF. This is actually what we call an ADR. You can see after the name of the stock, I'm going to do my best Spanish pronunciation of this stock. It's an Argentinian oil company. Okay. Sociedad Anonima. Anonima. That's how I would probably say it in Spanish. Okay. We'll just call it YF or YPF in our class here today. So it's been upward trending, and something that I have been kind of looking at recently, although I shouldn't say just recently because I do it all the time, is I like to see stocks that are really moving. For long option trades, yeah, we want there to be some movement. So I use these little scripts over here that are in my scratch pad, particularly 1 month and 3 months. Yeah, it's nice to have them in there. If I open this up right now, and we just kind of take a quick little look here. I'm gonna cut off what sector these are from. We have a 1 week return. I think I have that on here. If I don't have it on here, I'll post it in my post-production work, okay? Or you can use a monthly. What is the stock done in the last month? The really small numbers or negative numbers, you might not really look at them for long option call trades, right? But looking for some good movement can be really helpful regardless of what watch list you've got here, okay? This was actually just the results of a scan that Ben created one day. Now, I looked at this stock, YPF, and saw, man, it had a nice run up. Some of you might recognize that looks like a nice flagpole. And it does kind of consolidate a little bit. And then, if somebody thought this was maybe consolidating a little bit sideways here, yesterday somebody could have considered it a breakout. Or maybe today some people would consider the breakout. Or some people might say they would want it to see getting past the previous peak. So I'm looking at this and this particular stock. Let's do this. Let's change our watch list because I want to see those calculations. I'm going to grab class 2. And this should have some space on it. All right. We're going to put in YPF. And then we'll see what kind of movement this stock has had. This week it's up 10%, pretty significant. The last month, it's up about 28%. Okay, so is this a stock on the move? Yeah, it absolutely is. It would be nice if maybe you thought that the breakout was here to have caught that yesterday, but it's not up tremendously from that point. So I looked at the Fibonacci's and I drew a Fibonacci on here, measuring the most recent move to determine, hey, could there be a potential target out here that it would still be worth looking at? Okay, Fibonacci retracement is using this little icon here. It looks like a percent sign. What you do, you draw it from the top of the move. Okay, how do we know it's the top of the move? Because it has some pulling back right after it. So that would be the peak of that move. And I took it just down to the very bottom of this really small move here. Okay, when I did so, it put some extensions up to the top here. Said, maybe the next place this stock might get to is about 35 and some change. Okay, we could use that as a potential target on this one. So we're going to, all right, on the Fibonacci, targets up there, 35.22. What if we come a little bit below that? Maybe just say like about 35 as our target. And I'm going to make some notes here. And actually, let me collapse that so the notes can fit in here. So we're going to do a target up there at 35. What about a stop? You know, if this stock, for whatever reason, kind of came down from where it is today, we'd probably say, let's just close it down immediately. Okay, we're expecting the stock to go pop, pop, pop and continue on. And if it retraces and starts to go down, then we're going to put the kibosh on it. We're going to say, nope, we're going to get out. Try to minimize whatever that loss might be. So the low price today was 31. I was thinking maybe if we put a stop maybe 10 cents lower than 31, that would give us like $30.90. That our stop might go there. Let's make sure I got that number right. So the low is 31, yeah. So we're going to go $30.90 is where we're going to put our stop loss. Okay. Next, let's go do it. Let's go put the trade in. This stock's already traded 2.3 million shares. And what's interesting is it has some decent activity. It does have some weeklies, not enough to want us to participate in. Meaning there's not enough open interest to be really enticing, right? If we're looking for something in calls, we got 10 contracts, 40 contracts, so not a whole lot. And we do want to give it time to move and usually buy a little bit of a buffer. So some people might maybe even be trying to decide between the December options and the January options. If you're more comfortable buying a little bit more time, go ahead and do that. That's not a problem, okay? Because if it makes the move, you go ahead and you sell your option, that time, whatever it was you bought, you're just kind of selling it back, okay? So as I looked at these, you know, I'm really a stickler on that open interest. I really like there to be lots of contracts out there. If there's a puny number like a 6, I'm just going to avoid that contract altogether, okay? So we're going to go with this one that has at least 185 contracts and probably a few more from today. So we're going to go with the 31 call. All right, and we're going to put in that target and that stop with the expectation that the stock's going to move for us and every day we'll cinch up our stop loss. Okay, so let's go ahead and we're just going to say buy custom and let's just do with a stop, and we're going to do it based on the price of the stock. So we're going to change this to a market order. We'll make it good till canceled, and then we're going to go put on the conditions on the next page, right? Click on the gear. The order conditions come up here, the order rules, and we're going to say, all right, if the price of the stock gets greater than or equal to 35, get us out of the trade. We're just looking for a little bit of a move there. But if it goes down lower than today's low, which we've pegged at $30.90, then get us out of the trade. What's it going to do? It's going to trigger a market order. We don't know what the price of the option would be at that point, but knowing that we're working with liquid contracts gives us the idea that, okay, likely we would therefore have protection there, okay? All right, so there's our market order, good till cancel. We've got our 2 targets, stop and a target. We're going to do, in this class, since we can risk up to, I think we'll do 750 in this class. Sometimes I'll do 1,000. Let's do 750. That means, we could only do 2 contracts. Okay, so we'll do the 2 contracts. That's fine. We won't do more than that because we don't want to overload. We don't want to go beyond our risk tolerance. And we'll go ahead and we'll put this in our long options bucket, again, with the idea that we're going to watch the stock actively. Suppose it goes up, say tomorrow, right? Goes up tomorrow, then maybe at the end of the day, you come and adjust your stop to be a little bit below the low of yesterday. Okay, and the idea is to kind of cinch it up as it maybe works its way, hopefully up to our target that we've identified here with Fibonacci. Okay, so that is going to be our non-earnings play. They already had their earnings. Apparently, it went fine, and it's been running a little bit after that. So we have our earnings hedge on NVIDIA. We have our earnings straddle for implied volatility. Now, this one, we're going to look for actually a move. okay, and move up to the target. Now, I told you on our smorgasbord, I told you we had some bullish and some bearish. In a market that is primarily bullish, you might not want to load. It's kind of funky on the implied volatility there. You might not want to load up on bearish positions. Okay. I want to take a look and see which of these is looking more bearish. Okay, I have a couple picked out that we could have some fun with. TMDX is going to be one of them. Let's see what's going on with this. Had been bullish, had its earnings. Whoa, I guess it disappointed, didn't it? It did disappoint. You can see on this, we've got some support maybe about out at 70, but that's a ways down. And so I did a similar thing here with the Fibonacci. And I said, let's just measure this small move. Okay. On this Fibonacci, I started at the top. Okay, you click on your print or your little icon that gives you your Fibonacci. Click at the top of the move and then drag it down to the bottom of the price. Okay, so wherever that low is, that's where we pull back to. Now, when we are looking for a bearish target, we started at the top and we want it to go down. Now, we're going to have to do a little adjustment so we can see where that target might be. Okay, we already know that there's some support down at 70, but that's kind of a ways away with the stock at 88. So as we come in here to our chart settings, and we're going to come over here to price axis, and I'm going to see if I give us 25% room down, if that gives us enough of a look here. Let's see, that did give us enough, right? So we can see based on the Fibonacci that where it's expecting it to make its next move, initially it's back to the bottom of the move. And then the next target out there is actually a little bit beyond this 70 point. So I would say a real aggressive target would be down there at that Fibonacci extension. Maybe the more conservative target would be around here about 67.95. Okay, so what are we going to do here? We're going to buy a long put. And we're going to give it a little bit of time. Okay, usually when stocks fall, they fall pretty hard. This has a little bit of a move to go to those actual targets. So we're going to do a January option here. And let's see, it's at 88.74. So our at the money strike price is going to be the 90. All right. And 84 contracts, we got 11 there today. We're just going to do one contract here, so we should be okay. But if you trade 5 contracts, 10 contracts at a time, some people will do that with the size of their account. This strike price might not be enough open interest for you. So you might say, let's go and maybe out of the money at 85 or a little bit deeper in the money where there are some more contracts. Okay, we're doing just one. We're going to choose this one. So it's going to be 90. Let's see if we can get in at closer to the midpoint price. And then I didn't write down what our target and stop was going to be here. So let's put in our target and let's put in our stop. So our target, we're going to go for the one that's a little bit not so pie in the sky. Okay, we're not going to go to the 67.95. Looks like actually 70 will come a little bit sooner than that. Okay, so let's go out to say maybe $70.50. Let's give it that kind of a target. And then a stop. This one we're going to be pretty picky about. We are looking at a move here where it's just run up a little bit and it's doing what today? A close below the low of the high day. So we're just going to put this a little bit above today's high. We don't want to see it retrace and go up. If it does, we want to be out pretty quickly. We want to minimize our loss there. Okay. Some people, if they wanted to give it more room, maybe they'd give it to the top, the full retracement, because we're expecting it to just go flat or down. That's why we're going to use the tie today, which is 94.84. And let's say if it gets up to say 93, we're gonna call ourselves out. We're gonna say put our stop loss in there. Yeah. Let me see if there was a question specifically about this trade. I think it's more about using your control key on your keyboard. Sum those up. All right, let's go ahead. Let's put this puppy in place. Let's do this one more time. And let's just do buy custom with a stop. Going to do the same thing where we change it to a market order, and we're going to make it be based on the price of the stock. Go over here to our gear, and let's put it in place. All right, if it gets down to our target, less than or equal to $70.50, we'd be pretty happy about that. Would say get us out of the trade immediately. Or if it pops up and it goes above a little bit above our high for today, we want to get out as well. So that's what we're going to put at $93 even. Okay, it's going to trigger a market order. We don't know what the price would be if and when it touches one of those. Again, we're going to ratchet that stop loss. Okay, if it were to drop quite a bit tomorrow, then we might consider changing our stop on this side, all right, to be the low or the high of that day. Right now we've got it here at 93, so maybe it drops and you're like, oh, we can put it down here quite a bit lower, whatever that price is. Okay, so we would want to adjust it every day. Let's go ahead and hit save. And we're just going to do that one contract and put it in our long options bucket here. Very good. So we have a little bit, some bullish, some bearish, and earnings and non-earnings, and protection, not protection, we'll call it a hedge, in case, you know, that NVIDIA disappoints for whatever reason, okay? All right, Greg said I needed to check my less than or equal to signs. I really probably should have. Let's double check them in here. Let's go to our gear. So if, is that the wrong one? Did I do that wrong and it got us out immediately already? Our YFP that got placed. This one, okay, I did that wrong apparently. Okay, let's do it again. It got us in and out. Let me make sure I've got my pluses and minuses in the right spot. All right, we're going to buy a custom with a stop. Make it a market order again. Let's make sure we do the arrows the right direction. Okay, so our initial target is going down, right? So if it is less than or equal to $70.50, right? That's quite a drop, $8 or so, and is less than or equal to that. Okay, then we want to get out, and if it pops up on us, if it goes a little bit higher than today at 93, then we want to be out. Now I think I've got those going the right way. Less than or greater than 93 or less than 70.50. So I think we've got them right. All right, so not sure what I did on the previous example, but I needed to redo that. But hopefully I'm not blowing it. Oh, I put less on both of them. Oh, thank you. Thank you for catching that for me, guys. Appreciate it. That would have caused a problem. All right, now we're filled on it. Now we're going to watch it. Now, one thing I wanted to report back to was from last week. Okay, we did a couple of earnings trades, and maybe we can only learn real quickly here. They were a little tricky on us, okay, because we bought a call and a put, and the stock dropped. In fact, it was clear down here the next day. So I quickly sold the call and held on to the put. And for a while, it had some profits. But then what happened the next day? Huge surge the next day. So we had to get out here. And so we ended up losing on both of those positions. We don't have time to go in to look at the numbers. I'm glad we had the extra time because they would expire on this Friday. But that can happen on you where initially you pick one and close the other. If it doesn't move a whole lot, then you might be in a position where you go, well, let's just kind of give it some time to play out. Especially if maybe you thought the news was good and the market thought it was bad and it doesn't drop that much, then you know, you might have that as a consideration. All right, what would I want you to do? Play around a little bit with how much time you might need for whatever the trade is that you're doing, whether it's for protection for options or if it's something speculative or earnings or just a measured move. Just make sure you've got plenty of time for those trades. Well, I appreciate you being here today. Cameron, thanks for answering questions out in the chat. Again, I'll encourage you to do that survey, and I'll read every comment you read. So do our managers. We love to hear what's on your mind and give us that feedback. If this was helpful to you today, go ahead and hit the plus button. That lets others know and allows them to find it easier as well. All right, top of the hour, it's going to be Brent Moores with learningaboutschwab.com. We'll see you at the top of the hour. Bye-bye.